Hi, in this tutorial we're going to look at how to translate net income into cash flow. As you probably remember from chapter 1 when we went through the 8 principles of finance, one of our principles was that cash is king. Net income is not something that we get to spend, right? What we're concerned about is how much cash we have on hand, how much we actually receive, how much we're going to have to spend. And so one thing that we need to do is learn how to translate net income from a capital budgeting project into cash flow. So we're going to start with this example as though you're looking at buying a house in Arcata to rent it out to see if you can make a profit. And we're going to use that for the next 2 tutorials. Let's get started. So an example is that you're looking at purchasing an investment property. Right now there's a 3-bedroom, 1.5 bath condo for sale in Arcata for $229,900. You think that you could rent it out for $1,500 a month and that you'll have a bunch of expenses. You'll have property tax, which is 1% of the purchase price per year. You're going to need to pay homeowners insurance, which is $1,000 per year. You're going to have miscellaneous repairs that you think is going to be about $80 per month. You'll also have a write-off because of depreciation. You depreciate a home over 27 years, and so you'll be able to write off 1/27th of the value of this house every year as depreciation. Your income tax rate is 25% per year. And we want to know if this is actually going to be a good investment for you if you have a required rate of return of 10%. So we're going to start with our value drivers. What do we know? So our house price is $229,900. Our monthly rent is $1,500 per month. And every year we need to pay 1% in property taxes. Our annual insurance expense is $1,000, and we believe that we're going to need to spend about $80 per month on average in miscellaneous repairs. Our depreciation rate is 1/27th of our purchase price per year. I'm going to enter it here as a fraction. Our depreciation rate is equal to 1 divided by 27. I have it set to 2 decimals, but if you pull up your percentage, and they look like this, right, with no decimals. When it comes to percentage, you are always going to want to add at least 2 percentage points, right? If you get to 1 and they're both 0, give me at least 2 because you want to know if you're looking at 1% or is that 0.51%, right? You got to help Excel give you a little more information. Your income tax rate is 25% per year, and that's a flat rate. We know that. We don't need any more. And our required rate of return is 10%. Let's do a calculation of our net income, right? How much money will we make per year, net income-wise, if we buy this house and rent it? So let's look at some of our revenues and expenses. Our first revenue is rent. We know that our monthly rent is going to be $1,500, or at least that's our best estimate. So our annual rent is going to be equal to $1,500 a month times 12 months per year. What I want you to notice first off is that every single cell that I enter, I'm going to reference one of these value drivers because I want to be able to change any of my value drivers and watch it change everything else on my spreadsheet. We're not going to enter any numbers that may someday change. So our property tax expense is going to be equal to our property tax rate of 1% multiplied by the house price. So we're going to need to pay $2,299 per year in property tax. Before I move on, I'm going to give that a negative. And if I enter my expenses as negative numbers, it just makes it easier. Insurance is going to be set equal to a negative value driver, insurance, 1,000, and our other miscellaneous are going to be equal to our miscellaneous monthly repairs multiplied by 12 months per year. Additionally, we're going to have something that is an expense, but it's a non-cash expense, right? Depreciation is how we allocate the cost of a capital item over the useful life of the item. And so our depreciation expense on this house, we're not going to actually pay any cash, but we're going to pretend for tax purposes that we spent $8,514.81, and that's going to be a write-off, right? What a write-off means is that it reduces our income for tax expenses. And with depreciation, we don't actually spend any cash. So our reportable income for tax purposes, or our income before tax, is going to be equal to the sum of all of these things. I entered them as a negative number so I could sum them. You could enter it as a positive number and then subtract. It doesn't matter. What's important is the process. Like putting your M where it belongs. So our reportable income for tax purposes is $5,226.19. Our income tax is going to be equal to our taxable income multiplied by our income tax rate. And if I use a negative number here, it'll come up as a negative number. And then for my net income, I can just add these two things together. So my net income is going to be $3,919.64. That'll be my annual net income from having this property. Is that a good thing or a bad thing? You know, I don't know. A net income isn't exactly the thing that I most care about. What I want to know is how much cash this is going to deliver. And when it comes to cash flow, one of the things that we need to consider here is depreciation. So we need to go from annual net income to cash flow, and we've got two different methods we can use to get there. The first one is easier. It's calculating the cash flow by adding back depreciation. So we can start by saying, all right, this is our net income, but since I didn't actually have to pay out any depreciation, I can add it back. And my depreciation expense was equal to 3.7% per year multiplied by the price of my house. So my cash flow is simply going to be equal to the two of these. So from that property, I'll report a net income of $3,919, but it actually is going to result in a cash flow of $12,000. And it's because that depreciation isn't actually an expense that I have to incur. The second method is a little more convoluted, but it gets at the essence of the depreciation expense and why we like it. We like having a depreciation expense because it reduces our taxable income. It reduces our taxable income by the amount of our depreciation multiplied by the tax rate. Because we say that we have an expense, a depreciation expense, it means we pay less tax. So let's calculate our cash flow again using our second method where we compute our net income, but we don't subtract depreciation. And then we add the value of a tax shield. Let's start again. So our rent, again, is equal to $1,500 times 12. And we've got some expenses. First, we have our property tax of 1% per year multiplied by the purchase price of the house. Our insurance is going to be equal to $1,000. And our other miscellaneous expenses are going to be equal to our negative estimate of our monthly expense multiplied by 12. However, we're going to leave depreciation blank. We're not going to have any depreciable income. We're not going to have any depreciation when we calculate our net income in order to get to cash flow using this method. So when it comes to taxes, we are going to say that we've got taxable income equal to $13,741. If that's our taxable income, we're going to need to pay 25% of that, entering starting as a negative number, or $3,435.25 in taxes. So that would make our net income without depreciation equal to $10,305. So if we didn't have depreciation, we would pay $3,435 in tax. However, the depreciation shields our income from the impact of taxes. So the amount of cash it generates, essentially, that saves us in taxes, we call that the tax shield. And it's equal to our depreciation expense, depreciation rate multiplied by the house price, multiplied by our income tax rate. And this tells us how much tax we saved by having our depreciation as an expense. And if we add together our net income without depreciation and our depreciation tax shield, we get a cash flow of $12,434.45. Essentially the same answer, or not even essentially, exactly the same answer as if we used the simple method of method 1, adding back the depreciation. So the purpose of this tutorial was to show you that in finance we care not about net income, but about cash flow. How much cash is an investment going to produce? And in this tutorial, we walked through 2 ways to translate income into cash flow. In the next tutorial, we're going to use this cash flow to assess whether or not purchasing this house is a good investment, considering the fact that we have a required rate of return of 10%. See you in a minute.